Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey. Hello everyone. Today I will explain how to use moving averages. So what is a moving average? It's a technical indicator based on statistical methods, calculated with mathematical formulas. Moving averages are the most commonly used indicators. They are based on closing prices. For instance, the 10-day moving average, add the past 10 days closing prices, divide by 10 and you will get the moving average. This indicator is very useful and widely used by traders. Traders rely on it all the time. So what are the main functions of moving averages? Their primarily use is to identify the market trend, locate key support and resistance levels, and use those levels to determine entry and exit points. They give traders a clear basis for making decisions. Alright, now let's take a look at how to actually use it. Specifically, how do we identify trends? Don't go anywhere. We're about to dive into the detailed explanation. Here, we've added several MA, the 5-day, the 10-day, the 20-day, and the 60-day. So how do we determine the trend? When these lines are arranged in bullish order, what does that mean? Let's take a look. It means the 5-day is above the 10-day, above the 20-day, above the 30-day, above the 60-day, and even the yearly average. This setup is called a bullish alignment. The shorter the period, the higher it appears on the chart. That's a bullish trend. In contrast, a bearish alignment is the opposite. 5-day, 10-day, 20-day, 30-day, 60-day, and so on, all stacked downward. That signals a bearish trend. So we can easily assess whether the current market is bullish or bearish. Simple, right? Now, many of you might be wondering, how do we identify a sideways or range-bound market? It's actually very simple. When all the moving averages are tangled together and the price moves back and forth, there's no clear trend. That's what we call a consolidation or sideways market. Pretty easy to recognize, right? In a bullish trend, the moving averages line up in bullish order. In a bearish trend, they align in bearish sequence from short to long. But in range-bound market, short and long-term averages get intertwined and move sideways. At that point, there's no trend. No clear trend means we're in a consolidation phase, and that's how we determine the trend direction. Next, let's talk about identifying key support zones. This is also quite simple. How do we find them? Because the 5-day, 10-day, and the 60-day moving averages represent the average cost over those past trading days, essentially the cost basis of the last 60 sessions, for example. So these lines offer valuable reference points for price movement. They can guide us in reading price behavior. Take the 5-day average, for instance. It acts as short-term bullish trend line. When the price pulls back to the 5-day line, it often serves as support, helping the price bounce and move higher. Now take the 20-day moving average. That serves as a swing trend line. As long as the price pulls back to this level, it often acts as a support zone, helping the price rebound higher. That's because the average cost over the last 20 sessions is right here. So when the price returns to this level, it tends to find support. As long as the swing trend line holds, the uptrend can continue. But once the 20-day moving average is broken, it signals that this wave of bullish momentum has ended. At that point, we need to exit either by cutting losses or locking in profits, right? So what about the 60-day moving average? It's a medium-term trend line. As long as prices hold above this level, they tend to rebound upwards strongly. If prices can't surpass this line, the bearish trend will continue downward. Thus, when prices touch the 60-day line, it usually acts as a significant resistance. Prices rebounding towards the 60-day average often encounter selling pressure, limiting upward moves. That's the 60-day line. The annual line is the long-term trend line. As long as prices hold above it, the long-term outlook remains bullish. In other words, prices are likely headed higher. Conversely, if prices fall below the annual line, a bearish trend takes hold, driving prices downward. clear enough, right? Next, let's look at the 5-day average. It acts as a short-term trend line, serving as resistance, pressure, or support. Similarly, the 60-day or 20-day averages provide clear resistance and support levels. These are key trading levels. That's the second main function. The third function is to use these key levels to identify specific entry and exit points. These points guide our trading decisions. After confirming these key levels, let's say prices rebound upward to test the 20-day or 30-day average. At this point, if resistance forms and the prices fail to break above, we have an opportunity to enter short positions, right? Similarly, if the price rebounds but can't surpass the 5-day average, this represents a short-term opportunity for a quick short trade. Now, in this scenario, let's take a look. If price moves upward along the 5-day line, we can use the 5-day average as our short-term trading reference. When the price pulls back to it and holds as support, we go long. If it breaks below, we cut losses and exit. Makes sense, right? When price rebounds to the 60-day average, we assess whether the trend remains bearish. If it can't break above, then the mid-term or swing downtrend is likely to continue. In that case, say this stock rebounds to the 60-day average, fails to break it, and starts falling again. That gives us another chance to go short. If it breaks above the 60-day or a prior high, we stop out and exit the short position. That resistance level defines where we should place our stop loss. To the downsides, watch if price pulls back to the 5-day or the 20-day average. These moving averages help us determine precise buy and sell zones. They are key trading references. Does that make sense now? We first identify the resistance zones, then trade accordingly. Once the level is broken, that's our boundary. If price breaks above it, the trend has changed. At that point, we stop out and exit. If it doesn't break through, we continue with short trades. Right? Makes sense? That's approach. But at the same time, you need to be clear. Are you trading short term, swing trading, medium term, or long term? You must understand your trading style. That helps determine which strategy fits best. For short term trades, follow the 5-day line. Once price breaks below it, stop trading. Don't force it. Just cut your losses or use a trailing stop to lock in profits. That's a general idea. Alright, so we just went over the key functions of moving averages. They serve multiple roles in trading. Now let's talk about how to use them. There are a few approaches. You can use one moving average, two moving averages, or a system of three. Each method serves a different purpose. For example, one average. As I mentioned earlier, the 5-day moving average represents a short-term trend. The 20-day line reflects swing trends. The 60-day is for midterm analysis, and the yearly moving average that shows the long-term trend. If the price holds above the yearly line, the long-term trend remains intact. Makes sense, right? So you can use that line to guide your buy and sell decisions. This is how we apply a single moving average in trading strategies. That's the one-line method. Now, how do we use two moving averages? It's simple. You pair one long-term average with one short-term average and observe the crossover between them. For example, here you might use a 5-day average together with a 10-day average. Watch the interaction between the 5-day and the 10-day lines. When they cross, that gives you a signal to judge the short-term or swing trend and make your trading decisions accordingly. For example, at this point, when the 5-day and 10-day averages form a golden cross, we go long and ride the uptrend. Keep holding the position. When do we exit? When a death cross appears, that's our stop loss signal. Exit right away. Pretty straightforward, right? Now here, take a look. At this point, the 5-day and 10-day averages form a death cross. That's where we enter short trade. We open a short position right in this zone. Then we hold it until when? Until golden cross appears. That's our signal to take profits and exit. This range between the two crossovers is your profit window. Simple and clear, right? The same logic applies before this point, and it works afterwards too. Of course, this kind of trading has its limitations. In sideways or choppy markets, These signals can easily be false. During consolidation phases, crossovers may mislead you because this is a trend following strategy, and trend following systems don't work well in ranging markets. Every method has its strengths and weaknesses. It's crucial to understand where each method excels and where it doesn't. Only then can you capitalize on the strength while avoiding unnecessary risks. Take the MACD for example, or the KDJ indicator, or Bollinger Bands. Every indicator, every trading system, every technical strategy has a specific market condition where it works best. Truth in trading only holds under the right conditions. Without context, no strategy is absolute. That's why everything in the market has its limits. Each method has its domain. We must apply them only within their proper range of use. Alright, at this point we can see clearly the crossover method may not be so effective here. A single moving average can actually work better. Using two lines sometimes results in frequent false or conflicting signals, especially during consolidation phases when there's no clear trend. Two-line crossovers become unreliable. So in those cases, a single line works better. And because of this limitation, we can use a three-line system instead. That means trading with three moving averages. I mentioned earlier that two lines may not be reliable, and yes, they can sometimes give poor signals. When this happens, the three-line method helps. So we use three moving averages instead. How do we judge with three lines? That's also quite simple. Let me explain. Let's say, for example, we use a 5-day and 10-day moving average crossover to generate specific buy and sell signals. Then we use a 60-day moving average to determine the broader trend direction. If the 60-day line is trending upward, we only take trades in the same direction. In this case, long trades. So for example, here we only go long. We ride the uptrend as far as it goes. Now, if death cross appears at this point, do we enter short? No, we don't, because we're following the 60-day midterm trend, and that confirms our trade direction should remain long. We only trade in line with the dominant trend. That's the strategy. So in this case, we only go long, not short. This helps filter out a lot of false signals or poor trade opportunities. For example, we get a golden cross, go long. When the setup fails, we stop out or exit with a trailing stop. Then at the next crossover, we go long again and exit when the trade runs out of momentum. Same idea applies again. When a death cross appears, we treat it as a signal to exit, either a stop loss or a take profit trigger. We don't use it as a new entry point. That's how the three-line system works. It tends to improve your win rate. You're not trading against the trend, you are skipping the noise and only trading in the dominant direction, aligned with the longer term trend. So here we enter long trade. Another golden cross appears, we go long again and exit when another death cross occurs. That's our take profit signal. Simple and easy to follow, right? At this point, okay, we just apply the same logic to previous price action as well. Here we spot a bearish setup. So what should we do? When the price is below the 60-day moving average, we only take short trades, only short positions. At this point, when the 5-day and 10-day lines form a death cross, that's our short entry. We go short there, open the position, and hold it until when? Until golden cross appears. That's when we take profits and exits. Now, here's the key. When a golden cross appears, can we go long? No, we don't. We only trade in the direction of the dominant longer-term trend. That's our core strategy and rule. So in this kind of setup, we only go short, never long. Even if we see a golden cross, we skip the trade. We only re-enter when price falls again and another death cross appears. Then we go short again, and when another golden cross forms, we exit again. So whether in a bullish or a bearish market, we follow this principle. Trade only in the direction of the prevailing trend, and success rates go way up. If you rely solely on golden and death crosses between two lines, a golden cross or a death cross, you will often get false signals, especially in this kind of price zone. Right here, too, you will likely encounter frequent false signals. But if we add a third moving average to help us confirm trend direction and divergence, then we only trade in alignment with that trend. We stick to directional trades only. What does that allow us to do? We can eliminate many low quality or noise driven setups. We avoid those weak counter-trend trades, and by doing this, our win rate can go as high as 80% to 90%. So today's lesson was all about how to use moving averages to identify trends, locate resistance levels, and how to apply one line, two line, or three line strategies in real world trading scenarios. I encourage you to apply these methods in practice and build your own experience. Alright, that's all for today's session. See you in the next video.